Hello, everybody, and welcome to another Mastermind, Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to create and preserve more wealth, or help your clients, friends, and family do the same. When exiting any asset of any kind, as long as it has $1 million net proceeds, $1 million gain, it's a large feeling the pain of the capital gains tax. Today, we are diving into essentially where do you want to be? Where do you want to be? Whether that be in your business or whether that be in the sale of your asset. Clarifying vision is so important before you can get started to take and make transformation with the deferred sales trust. And so today we're all about focusing on vision, where you want to be, and then also clarifying where you're at right now. What is your capital gains tax challenge? What is the business that you're selling's challenge? What is the real estate you're selling? Wherever, clarifying where you're at. Because if you don't know where you're at, you're not sure where to go. And that's what we want to try to do, is then close the gap between where you want to be and where you're at, understanding the options that you have available to you. Because guess what? It's not just about building a business or building wealth. You also want to be able to exit well so that you can unlock freedoms that you desire, whether that be for your family, whether that be for being an entrepreneur, whether that be for making a difference and an impact with your time and your energy. Life is not necessarily forever, although today you can make decisions to exit really well, and that's what we're here to help you understand what the DST is and how to do this in a great way. And my name is Brett Swartz. For those who don't know me, I'm founder of Capital Gains Tax Solutions. And we are here every Friday, 10 a.m. Pacific Standard Time, 1 p.m. Eastern. We're streaming on YouTube, a couple different channels, the Capital Gains Tax Solutions YouTube channel, as well as the Expert CRE YouTube channel. So talking about commercial real estate, investing, wealth, tax, but a laser focus on using the deferred sales trust. I'm also joined by some of the best in the business at what they do. Certified financial planner Jake Miller, typically financial advisor, wealth advisor Jake Carpenter, and a number of other strategic alliances that also join us to help along this journey. Because guess what? One guy can only talk for so long. So hey, Jake Miller, how are you doing today?
Doing wonderful, Brett. Calling in from New Orleans today.
Excellent.
Kind of making it around the globe. I was in Florida yesterday, New Orleans today. I might be in Mexico, or I might be in Utah tomorrow. I just don't know yet.
You'll let us know on the travels. I'm in Orlando, a couple hours south from where I live now in St. Augustine, Florida. Here at a conference, learning from some amazing leaders that I might share a little bit of some insights today as well. But let's dive right into the topic at hand. If you could, in the chat, put where your first name and where you're from, and perhaps even what you're hoping to accomplish with being here today. It could be, hey, just general information, understanding the DST. It could be, I have a big, huge tax. If I exit my asset, or I have clients that are exiting multi-million-dollar assets, and clarifying that is really important for helping to understand where we're going to go with a lot of this. We're also going to be having some live events as well. So we're going to start doing some surveys. And this is a good way to also build and understand the more content to create for everyone. So if you could put that, that'd be very, very helpful. But what I found, Jake, is most people, they are learning from the DST for the first time, right? And they're trying to figure out what this thing is. Is it real? Is it legal? In fact, I was at a fund manager meetup last night, and these gentlemen create funds and they help people invest large amounts of money into these funds. And with real estate or business ventures, and I brought up the discussion of the deferred sales trust because they asked me, what do you do? I said, well, we use a strategy to help people defer tax on any asset of any kind. And I started to go into it, and they go, well, I might have heard this before. I had some guys tell me about this a couple of years ago. I said, well, tell me about it. What did you learn about it? And they started to go kind of down the trail. And I said, he goes, but I stopped them because they said that they had never had an audit. And I said, yeah, there's those that are out there that, either are copycats or they're trying to do something that we do, but they don't have that audit track record. And it's sort of like walking into a surgeon and you're wanting to do ACL reconstruction surgery. And guess what? He's never done a surgery. Or he's done the surgeries, but it's actually never been maybe tested to see if the ACL actually stayed, stuck around, right? And that's a big thing, right? You want to make sure that the audit protection is there, the track record is there. So Jake, talk about the track record of the deferred sales trust as it pertains to IRS audits, as it pertains to lifetime audit defense with Campbell Law Firm, as it pertains to just the certainty of the legal stability of the deferred sales trust.
Absolutely, Brett. In fact, that's that's actually how I came across the deferred sales trust, simply because I was serving as the back office support for an association of CPA firm owners. So the owners of these firms utilized me as the back office to do due diligence or to vet strategies that maybe their clients would bring to them and say, "Hey, I heard about this," but that CPA firm itself hadn't done that 100 times before. And so then they would rely on us to provide that feedback, that due diligence, and that investigation on their behalf. I came across the deferred sales trust, Brett, because it is a strategy that has held up in court cases. And that was actually incredibly important. Oftentimes, when you're trying to help CPAs or a firm, if they're deciding to take on a strategy and implement it within their practice, or to accept those types of tax returns within their business, they need to know when it works, when it doesn't in court cases, when it's stood up, and when it's been disallowed. The wonderful and fantastic thing about the deferred sales trust is that it's always stood up the test of time and to the test of audit, and has never failed or been disallowed. That's incredibly important. There have been over 22 notices, reviews, or audits. What are those? Again, a notice is just, hey, I need some more evidence or documentation, or I'm sending you a notice because I want to know more, right? And a review could be a cursory review, could be a brief review. It's, hey, somebody's actually going to talk to you, get on the phone and ask some questions. And an audit, there's various kinds of audits. Some of them can be a deep dive, which those deep dive audits are usually the most telling. And Brett, the deferred sales trust had a deep dive audit just a couple of years ago for an apartment skyrise building on the coast in California, in California, right? Where the owner was actually an Italian. So a lot of complications here: federal tax law, state tax law, and foreign ownership, all of which passed within about 3 months. Which, if anybody's ever been through an IRS audit, having a small little 3-month window and having it all come out at the end with 0 findings and 0 changes is a miraculous thing. And that's what Campbell Law will do for you. They provide lifetime audit protection should you need to be represented because of the deferred sales trust, not because of everything else you're doing, but because of the deferred sales trust. Then they will represent you for the IRS, and they will ensure that everything that they've done for you stands the test of time and stands the test of audit.
Perfect, Jake. Yeah, that's so well said. And I think it's important to understand the track record is batting 1,000, and it is thousands and thousands and thousands of transactions, and it's close to 30 years. These are some of just the stats, right? The figures that are important to understand. But as I was telling this gentleman last night at the fund who had heard about something similar, who was, he even said, "Hey, I'm very skeptical. My job is to be skeptical." And I said, "Hey, you should be skeptical because most of these things are too good to be true. They don't have the track record. They don't have a law firm to stand behind them. Or it's a secondary group that is doing them through another, and they don't have that unique track record of doing the audits." Right. So he goes, "Well, was there an IRS court case?" I go, "Well, there's no IRS court case." We said, well, because he goes, "I like to see like public knowledge." I go, "Yeah, I know most would." I go, "But so far we've never had to go to court with the IRS." And in fact, you could even say that's a reason why it does work, because until the IRS pushes it to the point where it could become public knowledge, right? In that scenario, and they have not done that. And it's thousands and thousands and thousands of closes, close to 30 years, but they've done the formal audits and they've done the individual audits. So some people think, well, is the DST an audit triggers? Does it trigger the audits? And the answer is no. It's never been on a watch list. It's never been on the IRS. It's never been on the dirty dozen, right? And in fact, it has a perfect track record. It's also not to be confused with the monetized installment sale. We get this every single day now because the IRS has recently issued to all really anybody who's done an MIS that it's a reportable transaction. And it's interesting because competitors or people who don't know, they read this notice and they go, oh, well, this must mean the deferred sales trust too, or could it mean the deferred sales trust too? And it's just blatantly not true. In fact, with the monetized installment sale, we think it's been around, more popularized in the last 5 years or so. And for a long time, people would ask us if we would do them or if we do them. And we say, no, we don't do them. The reason why is typically the way they're structured. You're getting a lot of the funds up front. They're saying it's a loan, but the money's going into your personal account. And when it goes into your personal account, that's a taxable situation. And so we've said they really have never worked, and this would happen, and this has happened. And so this is the common theme over the years for structures that have failed. They either push the side and they guise it as a 453 installment sale, but the money ends up hitting your account, but they still say it's a loan. And so just the fact pattern doesn't match up. Where the deferred sales trust is truly an installment sale, meaning typically 100% financing to the trust in exchange for the promissory note to pay you over time. And then you slowly pay tax as you receive it. It's fully reportable. The trust reports what it pays to you in a 1099. And you fully take that 1099, you report it to your tax professional, report on your personal tax return and pay the tax. And as you dip into principal, you pay tax. And so these are the common things that we help people to overcome the false beliefs. But more than just those stats and that understanding is telling a better story. And so I want to help everyone here. You might have a future state of, I want to feel comfortable, I can sleep well at night, knowing that I'm in good hands. If I use the deferred sales trust, that I'm not going to, regret it and have to go through, taxes and penalties and all of these things that would be a total nightmare. And the current state of, I don't really know, where, if this thing works, right? Like it doesn't work. And this is a big deal for me. Like I've got to sell my 10, 50, $100 million company or business or cryptocurrency or real estate. And this is a big amount of trust to put into groups like myself, Brett Swords, Capital Gains Tax Solutions, Jake Miller, Campbell Law, all of us. So you're at that state and you want to be at peace. And I would ask you to consider this story right here. This story, I think, helped this gentleman last night. This gentleman was a securities professional, and this gentleman, again, has set up, I think last year alone, they set up over 130 funds for their groups and for their clients, brand new funds to invest. And his minimum, he said one of the funds was $100 million that before they would look at any deal, it needed to be at least $100 million worth of investment. So I went on to tell him, there's a gentleman named David Young, and David Young ran with a gentleman or I guess partnered with or worked with a gentleman named Bill Gross. And these gentlemen built PIMCO from about 80 billion to 1.2 trillion, along with about 5 other gentlemen. And this is worldwide PIMCO, one of the most respected. I said, do you know PIMCO? He goes, I do. And I said, well, great. Do you ever heard of David? He goes, I haven't really heard of David, but I've heard of Bill Gross. Okay. And I went on to tell him that David and 5 others, after they got a big payday from PIMCO, they retired. And they started another group, Anfield Capital, and they started to build and help more clients, more of a boutique, more of a niche focus there, and kind of building their own business there versus PIMCO's. And about 6 years ago, they did an analysis, right? And they got approached with the deferred sales trust. And like most people, their current state seems like it's too good to be true. It feels like we've already heard about this. It sounds like something that could maybe be risky. Like we don't really know. And their future state was, well, if it could actually be true, then this could change everything, right? And so that gap is what they went on. And that gap was their due diligence. And they began a 2-year journey with the deferred sales trust, with the clients, with the banks, with the investors, with the investment opportunities, with this, with their legal team, looking at the structure, signing the NDAs. In other words, doing a thorough, proper due diligence, making a proper, deliberate decision, right, on whether or not the deferred sales trust was worth the risk versus the reward for their clients. And so 2 years passed, and they did like a 2-day summit. And this 2-day summit was with a tax attorney, our business partners who created the structure in the Midwest. They all fly there, and they do a big whiteboard, presentation where they're walking through all the boxes, everything you can think of. They're asking those questions. And guess what they came back with? Number 1, that might be the smartest person we've ever met. Number 2, we're all in. We'll become a part of the inner circle to be able to manage capital. And really, they don't they typically work with financial advisors. They don't typically work with clients at the client level. They actually are like money managers as a part of the team. And so I said to the gentleman, look, if it's good enough for David Young and his legal team after 2 years of due diligence, and these are some of the, most respected guys in the world for what they do, you think it could be good enough for you? And it helped. He actually said, you know what? I think it could. And I said, look, just take that open mind, take that curiosity, bring your skepticism, bring your legal team, but join us. In fact, we work on a no cost, no obligation basis where we can help you understand. I say, if you give me 5 hours of your time, I think you're going to be about 95% of the way there. Now, why do I say 95%? Well, because 5% is still that trust and that faith in us to take that next step forward, to close on the deferred sales trust and become a part of our family, if you will, to actually execute on this. Because like anything else, until you're fully immersed, until you're in it, you're always going to have some questions. And so again, the goal here is hearing this, especially if you're a business professional and you're helping your clients overcome the false beliefs of the deferred sales trust is too good to be true, is figuring out the current state where someone's at, their future state, understanding what that gap is, and then telling a story that they can really relate with someone they respect, know, like, and trust, that has done the deep due diligence to help them with the legal objection. With that being said, I'm going to open up to Jake Carpenter, another one of our wealth advisors that we work with out of the state of Washington. Jake, any thoughts on that way to help people comfortable with the deferred sales trust?
No, it's exactly what you said, Brett. The due diligence process is one of the most important things that someone has to take their time. And just exactly like you said, you need to bring your skepticism, you need to bring your questions, you need to bring your CPA, you need to bring your attorney, you need to bring your decision makers that help you make decisions, because the due diligence process is where you really determine whether it's something that's going to work for you or not. And once you get through the due diligence process, not only does it help you determine, okay, yes, this is going to work, but you also understand how you can use it to be an asset in your overall planning strategy. So this is a strategy that not only just helps you defer capital gains tax, but it can also help you address federal estate tax. We call it the death tax. It can also help you supplement or complement your retirement planning, your estate planning, business succession, wealth transfer, whether you want to be active or passive moving forward in your investment strategies. So it all hinges, it all starts with the due diligence process and getting the buy-in from your professionals to actually take a look at this with an open mind and a skeptic outset and go through the questions.
Absolutely. And so I know I heard a saying today, one of the top speakers, she helps to build the events for Tony Robbins, right? If you've ever been to a Tony Robbins event, I've been to one right now, and I've done some online ones, but COVID hit and she went from doing everything basically in person, Tony did, and then he went to everything online, or at least for a couple of years, right? Until everything opened back up. And it was interesting. She said that it was interesting because what was once impossible now has become easy through technology, right? Through Zoom meetings like we're on right now, and through the ability for information to be readily available, right? And technology to make things easier. And so part of what I love about the deferred sales trust is what people once thought was impossible has now become easy. And she was having to say that, hey, it was once was impossible, it's now easy. And it's not that the deferred sales trust is easy in the sense of, hey, oh, it's just, I can snap my fingers and it's done. It does take proper planning. We need to set it up prior to the close of escrow. We even like to do it prior to, it always has to be prior to the buyer removing contingencies. Unless you're in a 1031 and you're working with us, then we can save a failed 1031 exchange. We have a 1031 rescue plan. It's called the best 1031 plan. And that's also available for everybody. But my point is, what we're trying to do with these masterminds, with our brand new book, Building a Capital Gains Tax Exit Plan, you can find that on Amazon, hit #1 bestseller. What we're trying to do, we're trying to make what was once seemed like it was impossible easy. And I remember sitting at Marcus and Millichap thinking that the 1031 exchange was the only way to exit well and efficiently and maintain the control and maintain the tax deferral and maintain growing wealth through 1031 exchanges. And we thought, oh, the deferred sales trust seems impossible, right? That seems like it's, too good to be true. It seems like we cannot sell high and buy low. And now it's become easy. And part of why it's become easy is because there's so many transactions that have closed. And there's so many case studies now. And part of the 5 hours that I encourage everyone for listening to this is to get connected with our clients, get connected into our community, attend one of our live events. In fact, one of them is coming up in Ponte Beach, Florida, where with our number one strategic alliance, DLP Capital, we'll be presenting the deferred sales trust, and amongst clients, potential clients, and over probably 500 different investors, high net worth individuals who are all there looking to build their family, their wealth, their legacy, their leadership. And these are the type of opportunities where it's now actually easy as you spend time with us, as you connect with us, as you can consume content like this on videos, so that it doesn't have to, you don't have to act in fear. You can actually step in and like conviction that it's going to. And so I want to encourage everybody to think about that. And I also want to encourage people to think about not just your ROI, but your COI. Your ROI is return on investment. And we can go through the deferred sales trust, what are the fees, what are the average returns, the promissory note. But what's your COI? And COI is the cost of inaction. And there's a story about Warren and Catherine, and they actually recently, I helped them. I had the privilege to help them exit their $2.5 million property in Sacramento. And they were facing rent control. They were facing fires. They were facing increased insurance costs. They were facing the ever-changing, moving the goalposts, California regulations to be an entrepreneur or to be a real estate investment owner, to go from what you felt like, 20, 30 years ago, maybe even 10, California felt like they're on your side. They actually wanted you to provide the housing, the business, the jobs, where all of a sudden the leadership has shifted to a mindset where it seemingly more and more difficult to be a landlord. And they're looking at not only that challenge, right, and the cost of inaction to deal with a lot of that stress, but also the cost of inaction to not be able to spend time with their two most precious things in this world, which is their two twin daughters. They had kids a little bit later in life, and the kids are 10, and Warren is driving multiple hours in traffic, dealing with another challenge in a unit, managing the managers, also doing a lot of the work himself, and going, for what? He goes, I've built my wealth. He had just retired from his profession, and now he's finding himself pulled back into another real estate challenge, right? And he's going, I've got a couple $1 million here in wealth, he and his wife, and basically no debt and a very low basis, a tax liability about 40% of their gain. So at least $1 million of tax or so are going to pay, and going, I don't want to trade 15 units, which is the apartment complex. I have 15 problems. I don't want to trade that for 30 problems. I'm ready to spend what's most mattering to me, which is my time with my kids and my family. And so we walked through and we broke down what it could mean to him. The cost of inaction would mean more time and energy at the property. The return on investment was also really attractive because his NOI was about $120,000. And with the deferred sales trust, the way we structured the 10-year promissory note, this particular trust went about $2.35 million after closing cost. And he was able to get about an interest rate and a cash flow that's going to be paying around about $185,000 to $190,000. And so they said to me, you're saying to me, Brett, that we can increase our cash flow. We can definitely decrease our risk. We can definitely decrease our liability. We get some asset protection. Why wouldn't I do this? The cost of inaction is so high with time with my family, cash flow, stress. He goes, what seemed impossible when we thought 1031 was the only way is now becoming an easy decision because he spent the time with us to understand it thoroughly. And that's what we want you to do. We want you to attend these masterminds, attend our live events, check out all our videos, all of our playlists on YouTube, and then reach out to us, connect with us, and set a time to see if the deferred sales trust can be an amazing fit for you and your family. And that's the goal for today. So I want to open it up for questions from anybody. You can put it in the chat. You can also unmute yourself. If you're not with us live right now, you can go to capitalgainstaxsolutions.com and you can register. I would register quick because we're in the process of moving this to a different platform, a paid platform, due to the increasing opportunities that we have in front of us, but also wanting to level up all of our content for you. So look for that coming. But in the meantime, we do offer this at no cost, no obligation as it pertains to joining us. And so let's see if anyone has any questions or thoughts in the chat. You can unmute yourself. I do see Claire. I do see John. I do see Maria. I do see Madeline. I do see Joe. Would anyone like to ask a question, have a comment, a thought, anything at all? We would love the opportunity to help you right now.
I think it would be good to hear from John. I know that we've spoken maybe 3 times now. I don't know, John, if you have anything you would like to add about what you've learned or any questions that you might still have.
Yeah, hi guys. Can you hear me okay?
Yes, sir.
Okay. All right. Well, my strategy is to, home builder. So I'm trying to take some excess cash I have on some of the homes we sell and throw it into the defer that capital gains, short-term capital gains, and then kind of create almost a retirement plan with the deferred trust and have that trust then invest in more midterm to long-term properties, kind of defer that gain. My understanding is we can borrow from the trust up to 80% of the value of the trust. So the trust would be kind of a perpetual ongoing, that's how I envision it. And every house we would sell, we would throw the money. Obviously, we'd hang on a few of those houses for cash flow purposes. But once we get to that one threshold, we can start throwing those, defer that capital gains by throwing those sales into a trust. And money that's in that trust would just kind of accumulate, so to speak, and maybe into other longer term rentals. So using the 80% borrowing, reinvesting, that my understanding is we can still recapture some of the depreciation then if we form another LLC, have the trust be an 80% partner in that trust, the new LLC. I have things to kind of work around that, but I'm trying to use the trust as a retirement account as well.
Yeah. So Brad, I've had a chance to speak a few times with John. Maybe in your own words, how do we use the deferred sales trust for a developer like John so that he can create his own portfolio and use his trust to partner with himself and do more projects?
Yeah, I mean, that's a great question. We'll walk through that here in a second, John. John, nice to meet you. Where are you calling from, John?
Calling from Manhattan, Kansas.
Okay, excellent. Great. And John, what would you say, fast forward, it's a year from now, you've been able to do all the things that we just talked about, right? And what's the one big thing that you'd say that would help you accomplish? Like, what is that, either that freedom, that flexibility, that peace of mind? What is that thing that's going to be, this is where I want to be? Can you just, in one sentence, could you say it? What is it going to give you?
I would say tax deferred growth. And also it's using a midterm strategy to finance my retirement. I've taken a strategy, there's different avenues to get to retirement. It's either an IRA account, which I do some self-directed in an IRA. However, there's some income caps, how much you can contribute into your self-directed IRA. Mm-hmm. So I'm using that strategy, but I ran across Jake with the DST idea, and it kind of fits my needs. We could do the 1031s, but sometimes a 1031 with all the time delays may be a little bit cumbersome.
I'm with you. I heard get to retirement. I think so. It's focused like a laser on that. So maybe is it a cash flow number? Have you clarified the vision for what number you need passively? Because what's assume, retirement is you don't have to actively do a 1031 or chase properties or do tenants, toilets, trash, all that. Do you have that cash flow number per month, John?
I'd like to get about 20,000 a month.
Okay.
That'd be comfortable.
Okay, good. And what's your current state? So on the rentals that you have now, and or the other income or whatever, are you active, right? What's your current state of income per month right now?
We're probably about 10,000.
Okay. And what's the valuation of the assets that you're considering selling? So how many do you have? What's the average value? What's the
Well,
average debt?
if we
Yeah.
do, say maybe I'd build 20 houses a year, I would probably hang on to the first 10 just to reinvest back into my company just for working capital, so to speak. The other 10 then in excess of what I don't really need the funds out of that profit to reinvest or sell those on the deferred trust. So maybe 10 go into
Okay.
the trust, 10 stay out of the trust. So maybe
Okay. So it's like a
40,000.
diversification. Instead of holding all of them, you'd sell some of them, but keep some of it. What you're saying?
Exactly.
Okay. Got it. And so the other thing too is how you're structuring your business. It sounds like you develop about 20 houses a year. Is fair summary?
Right. Correct.
Okay. And so you might be classified as a what's called a dealer. Are you familiar with that, John?
Right. Mm-hmm.
Okay.
Right.
So there could be some limitations before we go too far down this path with the deferred sales trust as it pertains to being what's called a dealer, right? And actively developing so many properties per year on whether or not we can use the deferred sales trust. And so I just want to make sure that we set that expectation up front. Now, let's assume there is a way structure the business where you could use it, right? Then as you were to exit, yes, you could move, parts of these houses into the trust. Also, you might even hold on to these properties for a longer period of time versus not just 20 a year. This might be something where you have built over a period of a certain amount of years. They've got a 1+ year ownership, and maybe they wouldn't be considered dealer status, right? So there's a couple of things there, but let's assume that you qualify, it all works. By the way, this is part of what I think everyone is learning on the fly. It's not a one size fits all. We definitely have to customize and look at this. But it's part of why we do a no cost, no obligation analysis with the tax attorney to see. And that scenario, John, on those 10 houses you would sell, what's the average value per house?
Sales price or profit? Probably say 40 to 50,000 per house.
Okay. And then are you looking at, I guess when you say profit, is that the profit? Is that net of all closing costs and everything else?
Correct.
Okay. All right. And then the basis then itself, what would you say? Maybe back up again. Average sales price, average basis.
So you got $350,000 house sales price, and you have probably 300,000 in it.
Okay, got it. And then the debt, you said the debt would be about 300,000 as well.
Right.
Okay, got it. So the other thing we found too, John, and it's a good case study is if you don't have $1 million net proceeds, $1 million gain per transaction, unless you have two at $500,000 each, the deferred sales trust is typically not a good fit either. And the reason is because the cost to do these transactions, unless you're going to sell them in bulk. And you may have, Jake probably said this to you, but I'm just sharing it for everyone else as well. So do you feel like you would sell potentially all 10 houses in one entity in one escrow, or does it feel like you'd probably be selling to individual home buyers to maximize the price?
A couple of different strategies. Yeah, probably at this point be individual. Now, the other strategy I had was if I hung on to say those extra 10 houses for rentals for maybe 2 to 3 year holding period, and then sold them off then either to individuals or as a group. I'm thinking more along the lines of selling them individually though, after a whole period of, so you'd be selling a portfolio of 10 houses worth, say, $375,000 a piece, then after a whole period of 2 to 3 years.
Okay, good. Yeah. So these are all good conversations to be having, right? And to be looking at. But let's imagine it did all work out. You're able to exit all these houses. You have a pile of equity that's built up. It'd be multiple promissory notes, or if you can package it all as one, might be one promissory note. And that could be invested into other real estate with you, right? And it's not borrowing from the trust. And I think you kind of caught what you said after you said it. Because if you borrow from the trust, that's taxable. That goes back to the monetized installment sale, where basically they would put the money and then they would say they loan against it, and the money just goes into your account. So you never borrow against the trust, but you do joint venture partner with the trust. And that's what allows it to remain tax deferred by forming an LLC and by forming a legitimate joint venture partnership, where you're the general partner, you're the managing member of that LLC, and you're going to build those houses or buy those rentals or whatever you're going to be doing. And that's the beauty of the deferred sales trust, that can give you that flexibility to be an entrepreneur, to be passive, to be a real estate developer, to be a real estate investor passive, to invest in liquid investments while you wait for the real estate market to shift, where interest rates make a little bit more sense. But that's the general framework, John. We definitely like to spend more time one-on-one with you and Jake and myself and the tax attorney to see if there's a way to structure this to make it a win-win for everybody. But those are the initial thoughts. Any other thoughts, John, before we go on to the next question here?
No, yeah, I'd be glad to sit down with you guys and talk a little bit more in detail. Like I say, it's kind of a concept I had, it's a matter of getting it structured then. So
good. Jake Miller, you want to add or subtract anything before I jump on to the next question here?
No, I mean, this is a prime example of something that could work or it could not, just depending on how John wants to continue to reinvest and work with the trust going forward. I believe that John's vision of the future is very flexible, and so the possible outcome of a deferred sales trust could work for him time and time again. One thing that I just answered is that we've had so many people ask me, do I need a new trust every time I sell something? And the answer is no. You might get a new promissory note, but you can use the same trust to receive all of these assets that you then sell. And that way you're not taking on constructive receipt of the proceeds. And so,
very well said. I'm going to bring Jake Carpenter in here. Jake, we do have a question from Joe, and Joe asked the question: what are the advantages of a deferred sales trust versus an installment contract? He put trust here, but I'm assuming he's referring to deferred sales trust. Joe, by the way, real quick before Jake answers that, there's thousands of different trusts, like a living trust. What we have is it's a business trust, and this trust is to do business by buying and selling assets and issuing installment sales. And so what we actually are doing is a trust with an installment sale. But Jake, answer the question: why wouldn't someone just do a traditional installment sale, Jake Carpenter, versus the deferred sales trust, which is the installment sale?
That's a really good question. And a lot of it comes back to how much, with the deferred sales trust, it's a very, very clean transaction where you're able to technically receive all of the proceeds into the trust. The asset is then fully out of any kind of liability that could blow back on you. And now you can set up your investment strategy. So the biggest thing that when I speak to someone about traditional installment sale versus deferred sales trust is you're going to be on the hook and or married to that partner, so to speak, the person purchasing on paper. If it's a business, if it's real estate, or maybe it's a farm, they have to perform in order for the length of that installment note in order to make things happen and go the way you want them to go. If they don't perform, you might be forced to retake over that asset and have to then come out of retirement and then have to get it going again, getting the business going, getting the farm going, managing the real estate. Now you're back into the trash, toilets, tenants, liability, and management. And so a lot of our clients, they want it to be very clean. They want it to have this point at which they don't have to worry about coming back in, managing the property, managing the business, managing the asset. Because remember, the deferred sales trust works with more than just real estate. It works for business sales, stock sales, farm sales, any kind of highly appreciated asset. And a lot of our folks that have done installment sales in the past, they understand the liability of having to trust that whoever you're selling it to is going to perform at the level you're expecting in order to create the income to pay that installment note.
Yeah, very well said, Jake. Yeah, and I'll just reiterate a couple things and maybe add one or two. So the first thing would be liquidity, right? If you are carrying paper back for a business or a real estate sale, by definition, that means it's illiquid. I mean, it could take 3, 6, 12 months, or who knows how long for that asset to be sold for you to be paid off. Number one. Number two, having liquidity gives you the opportunity to invest into other investments at optimal timing. And then we think this is so crucial because we think there's going to be opportunities to invest. So people are doing installment sales thinking they're doing the buyer a favor, which they are, maybe getting a little bit more of a premium, which they probably are because their interest rate is maybe at a 5 versus like an 8. But what they're forfeiting is the opportunity cost for having liquid capital in 3, 6, 12 months from now when the deals come up. And the problem is their money is still stuck in the old deal, right? And so you're basically, tying one hand behind your back. You want the opportunity to be liquid, diversified, to be able to create wealth when opportunities arise. And so that is so important, is that flexibility of the capital to invest into any asset at any time, not just any asset class by diversification, but any asset of any kind. As well, remember this gap analysis, right? Like, why are you selling in the first place? Like Jake mentioned this. Well, I don't want any more toilets, trash, liability. I want to maybe be a little more passive. Well, the worst case scenario is you get really comfortable in 24 months and you're living your passive lifestyle just to find out that you need to foreclose on your business that might be worth half of the value that it used to be because the person ran it into the ground. And now you have to force yourself back out of retirement and back to an active owner of that business or that piece of real estate. Why not just sever the complete relationship with the real estate and not have to be forced back, or the business not be forced back into this, I'd say, marriage, if you will, or that season of life. And remember, the reason you're selling in the first place is probably not to have to go back. And so with the deferred sales trust, we're going to ask the buyer to come with the full amount at close of escrow, whether through a bank or cash, doesn't matter. You're not going to finance the buyer, you're going to finance the trust. And the trust is ultimately going to sell the asset, your asset, to them. In exchange, you're going to get a promissory note. All right, probably very similar to the other promissory note. In this scenario, though, great. 5% would be more of a conservative rate, 6, 7, 8, maybe even 9%. And so we're typically able to increase your cash flow, obviously increase your liquidity, give you diversification. And then the most important thing is that timing piece, so that you can build more wealth by partnering with the trust. And so again, what used to seem impossible is possible. It's actually easy now when you're working with the right team to help you execute this. I'll add a little bonus as well. You have estate tax, right? You might have a large estate, and by doing an traditional installment sale, guess what? Not only are you limited to $5 million per person per year before you have an interest charge, but if you use what's called the DST plus, which by the way, that means it's still inside of your taxable estate on the DST 1.0, which means it's subject to the 40% death tax. However, use the DST plus, which is different than a traditional DST or even a traditional installment sale. We're removing those funds outside of your taxable estate. What that means is a huge amount of legacy that, instead of being in the government's hands when you pass away, it could be in your family. Your children can be the heirs of that trust. So that's a little bit of a bonus for those that are ultra high net worth. That being said, we're going to run to the next question here. And by the way, if you want to learn more about this, you can go to capitalgainstaxsolution.com. And Mevlin says, just doing an installment sale on my business of $300,000 and yearly increases. Okay. For 20 years and a total of 8.5 million, where would a deferred sales trust fit in? So I'm not quite sure I understand completely if you mean the payments of 8.5 million, but Mevlin, you want to jump in and clarify that?
Yeah, so it's a $300K yearly payment for the sale of a business. I sold the business for 8.5 million, and I did it in an installment sale to pay 300,000 with a 3% increase. So it totals 8.5. Got
it. So basically, you set up an annuity of payments. So like it's $300,000 a year plus 3% every year. Maybe it increases, right? And it's going to go over 20 years, and the total would be 8.5. So you kind of did 100% financing for them to pay you over 20 years. Is that a fair summary?
Correct.
Excellent. Now, when you sold for 8.5 million, did you have any debt on the business or no?
No, not really. And yes, but nothing that was significant.
Okay. Was the adjusted basis zero? What was your basis?
Honestly, I don't know the answer to that.
Okay. It probably is. I mean, a lot of these sales, I don't know what business you're in, but a lot of them are, you started from scratch and you probably fully depreciate it unless you had bought the business, where you had a basis, but let's assume it's zero for right now. Okay. Now, I guess the next question would be, since you said you're in New Jersey as well, right? Or in New York, a business in New York, and you're in New Jersey. So it's definitely a high tax state. So there's a couple of tax flow and cash flow things to consider here. Number one, are you needing or wanting, no wrong answer here, that 300,000 every year? Do you feel like you are spending that, or are you just paying a lot of tax on it? That's the first question.
So this sale actually hasn't fully gone through. It goes through before the end of year.
Okay.
So, but no, I wouldn't be I mean, yes, everything is pretty high over here, but no, I'm not just spending it. I'm also saving it. I'm looking to invest actually.
Okay.
A good portion of the 300,000 on a yearly basis in real estate.
Okay. So then the next one that helps into real estate. Now, on this sale for the 8.5, Evelyn, do you feel like you're getting a premium because you are financing such a favorable term for them, or do you feel like that's the price and you just want to do it to defer the tax? Or what's your thoughts on that?
It was more to just defer the taxes, just instead of getting 8.5 and then having to pay capital gains on that.
Yeah.
I just didn't, my lawyer thought it didn't make sense.
And he's right, by the way, because just so everyone knows, and depending if it's a C Corp, S Corp, LLC, but New Jersey, New York, California, Illinois, it's probably at least 40% of that 8.5 million would be completely gone if you took it all in 1 year. And so what you're doing is you're thinking, well, it's a law of compounding interest. Instead of paying 40% of $8.5 million to spread it out and earn interest over the years, and then also probably even drop into a lower tax bracket as well as you're receiving that. So there's significant savings. So you're looking at 3.4 million that's going to be working for you over the term. So let me ask you this. So do you think the buyer cares either way? In other words, do you think they actually could cash you out, Evelyn? And then I'll make the offer for what I think is probably even a better fit for you. Do you think he could come with 8.5 million or get financed?
I don't.
Okay. You don't think they could do it? They need you to finance, is what you're saying.
Correct.
Do they need to finance you all of it? Can they come with $1 million down, or do you feel like you need to really finance all of it?
It's all of it. Yeah.
Okay.
Yes.
Okay. Yeah. So it does sound like in the beginning, in this scenario, the deal itself is dependent upon you financing them essentially 100% and letting them pay you slowly over time. A. B. It also sounds like you want to invest into real estate, which is great. We love real estate. And hopefully you have I'm assuming you have a good feel for that as well. Let me ask one other question too, in case this deal doesn't work out. If you were to go to the open market without having to finance someone 100%, Evelyn, do you feel like you could sell it for 7, 6, or in other words, do you feel like you're getting a premium at 8.5 because you are financing?
So actually the business is probably worth somewhere between like the 24, 27 mil. It is actually a separation. So I'm being bought out for my part. My 50.
Okay.
Yeah.
You're 50%. All right. That helps. Interesting. Wow. So do you think the total valuation, let's just call it 25 divided by 2 is 12.5. So you're actually giving a discount at 8.5. And I could imagine this could be a really stressful situation. Are you fully committed to this deal, Evelyn? Because it does feel like perhaps it's not as advantageous for you if it's a lower price and you're having to finance 100% of it.
Yes, there's a backstory to that. So yes.
Yeah. Okay. Yeah. We don't want to be too personal here. I get you. So let me give you some offers, okay? Or some opportunities or some options, a better way to think about it. Okay. So we can structure the installment sale to roll into a trust. Okay. So it can still be what you have there. What is the interest rate that you're allowing? Is it just 3% or is there an interest
3%.
rate tied to okay. Got it. Yeah. So if we were representing you, right, and if we were working with our M&A advisors and everything else, we would definitely have structured this differently, right? And if there's any way for you to, you want a second opinion here, We have the groups to help with that. Some of the best in the country that do M&A and a lot of that kind of thing to negotiate. But it sounds and feels like, and it seems like you have a 3% interest rate, which right now interest rates are 6, 7, 8%, right? For a business, it could be 9, 10, 11%. So you're giving them a heck of a deal there. Number two, you're taking a discount from 25 million to half of that is 12 and a half or so to 8.5. So that doesn't seem equitable as well as it could be. And then next, you're doing the installment sale over 20 years, where you could be taking the capital with the deferred sales trust. If they actually could buy you out, you'd use the DST, you'd have a higher interest rate, you'd have the liquidity, you'd have the diversification, and you have the freedom. The best part is to invest into real estate right now with more capital, all tax deferred. And so what I'm saying, to be as blunt as I can for everyone who's listening, is, and every single reason why you wouldn't do an installment sale is happening right now, Mevlin. And unfortunately, it feels like you're probably stuck in the deal because you've already signed it, you're committed to it. And again, I don't know the full story, but the deferred sales trust can be transformational because it could give you liquidity, diversification, higher interest rate, more opportunity to build wealth now versus having to wait for 20 years to get the full amount of the $8.5 million while still deferring the tax. In other words, it solves all of the baseline things that you want solved with an installment sale, but it gives you so much more. Are you seeing that?
Yeah,
I just want to
absolutely.
make sure you're seeing that.
Absolutely. I hear
Yeah.
you. And obviously I would have to do some due diligence as to that of
Yeah.
the deferred sales trust, but that I got the bigger point was, if that full amount can be paid, then this is just, it makes complete sense.
Yeah.
But if it can't, then in my
Yeah.
personal case, that's where it gets
And by the way, Mevlin, I've seen deals blow up in the 12th hour. So you never know what could happen in this conversation, because now you can be empowered with this other option versus feeling like you have to stick to the current deal. And maybe you do, maybe you still do, but maybe you don't. And if you don't, this could mean a lot of, more freedom, flexibility, diversification, and really wealth for you and your family. Jake Miller, he's always insightful for these types of add any or subtract anything in there?
I would always just say that having options is empowering in the sense that you're not forced or pigeonholed into any one type of strategy. Ultimately, if things do change at the 11th hour. And, the last item that I would add is just that the deferred sales trust is quite a bit more flexible. You're not locked into certain installments. You're not locked into certain time periods or thresholds. And that your ability to reinvest with deferred dollars rather than the other way around is what makes the deferred sales trust a very powerful financial tool moving forward with other strategies.
Very well said. Mevlin, feel free to, I want to send you a link here in a minute, and you can book a time with myself, and we can kind of dive in a little bit further if you'd like to. Okay. So look for that link coming your way. That being said, does anyone else have any other questions or thoughts before we wrap it up? We're almost at the top of the hour. I want to encourage anyone to take action right now by going to capitalgainstaxsolutions.com to schedule a time. If you have a sale that has a $1 million net proceeds, $1 million gain, it's a no cost, no obligation call where we just review sort of what we just did with Mevlin and John to see if the deferred sales trust could be a great fit for you, answer your questions, and really just do the planning, because this does need to be set up prior to the close of escrow and typically even prior to going under contract. Although we can also put it in prior to the buyer removing all contingencies, but having options, having this knowledge, having a team to help you through this is going to empower you to make better decisions and have better outcomes. Because the deferred sales trust is that special. And by the way, you can learn more about that too by checking out the book, Building a Capital Gains Tax Exit Plan. It's on Amazon. Jake Miller is in the book. I've got a couple chapters too. I know it's coming in blurry here. And then we have Kevin Harrington from Shark Tank in the book as well. Let's see if that goes better when it goes up against my face there. Okay, that being said, Jake Miller, where can people find you if they want to find you?
At strategictaxsolutions.com, as well as if you want to see a replay of this session, both Brett Swartz has a YouTube channel as well as I do, or my LinkedIn, and you can watch a replay there.
Yeah, absolutely. Thank you so much. Jake Carpenter, if people want to find you, where can they find you?
CarpenterCapitalLLC.com or 509-396-5292.
Excellent. Yep. And then people want to, again, watch the replay, go to Capital Gains Tax Solutions, Capital Gains Tax Solutions YouTube channel. You can also go to capitalgainstaxsolutions.com to get our free ebook. And then you can go to Expert CRE Secrets as well. We have another YouTube channel that we just kind of co-stream information and all of our podcasts. And of course, check out the book, Building a Capital Gains Tax Exit Plan. Hey, I want to thank everyone today. I want to thank John and Evelyn in particular for your participation and your great questions and thoughts. Jake Miller, as always, Jake Carpenter, it's always a pleasure. And we appreciate everyone out there. Go make it an amazing, amazing weekend. Take action with the information, understand where you're at, your current state, your future state, where you want to be. What's that gap that's holding you back? We want to help you, erase that gap by getting comfortable with the trust, the team, the outcome. Go to capitalgainstaxers.com. We'll talk to you again real soon. Bye, everybody.